Real Estate Show with Pat Lopez, where we talk everything real estate. Today, my guest is Jason Saperton, VP of Business Development at Quaint Oak. Jason, welcome to the show.
Thank you for having me.
Great. Okay, so the last time you were on, we were talking about some of the changes that Fannie Mae, Freddie Mac had with condominiums and some of those guidelines. So there's been some more guideline changes, and specifically with multifamily and the down payment. So can you elaborate and tell us some of those changes?
Absolutely. So we're excited, actually. In this case, we've got some positive changes coming with condos. We discussed some tightening of guidelines that they were looking at. In this case, we've got positives, which is always wonderful to look at. And Fannie Mae has come out and they've allowed an expansion of their loan to value requirements for multifamily units. So what we're seeing is now for a primary residence purchase or a limited cash out refinance, you can actually go to as high as a 95% loan to value. So that's only 5% down on a 2 to 4 unit, where that was previously was for a 2 unit, we were at 85%. So
Right.
That's a 10% swing right there. And if you were doing a 3 to 4 unit, that was 75%.
Okay.
So we're going from basically 85 and 75 as far as the loan to value to now only needing a 5% down payment at 95 loan to value.
Okay, so let me just elaborate. When we're saying loan to value, we're LTV, we're talking about your down payment. So now, if it's a primary residence and you're doing like a home possible, home ready, that kind of thing, you could put 5% down where before it was 15%, all the way up as high as maybe 25%, right?
Absolutely.
So, hey, if I'm looking at a $100,000 house, I'm putting 5% down now potentially versus having to put, 15,000 up to 25,000, which is a big difference.
Absolutely. And it's going to have a huge impact to some of the more urban type markets,
Right.
like a Philadelphia, where there are many multi-unit properties that are available that people do buy for primary residence for one unit for themselves and either a generational
Right.
for the other units or to rent them out and help pay for that primary unit.
Right, and that's smart. A lot of people are looking for those multifamily, live in one to offset their payments, that kind of thing. So great. Okay, so that's some good news. Also, there's been some changes. If I live in a home, I want to keep it as a rental property, but I'm buying a new property, that now the calculations of that rental income, is a little bit different. So can you elaborate on that?
Absolutely. So, if you are vacating a property that's a primary residence and you're going to rent it out, right? Before, for the most part, the best you could do is essentially wash the payment, right? So no matter how much rental income you were getting, at most it could make that payment a zero as far as
Right.
what it was washing it out. However, now there's been a slight change that if you have a history of managing properties for at least a year, then you actually, if the rental income is high enough compared to the mortgage payment, taxes, insurance, and whatnot, you could potentially end up with a positive rental income from that property. We've seen that as a huge impact for borrowers,
Right.
where they go from maybe not being able to qualify or to qualifying or even being able to qualify for more
Right.
of a house.
Okay.
It's a big impact.
So once again, I live in a house. I want to keep it as a rental. I could have no mortgage on that home,
Mhm.
or I could have a small mortgage on that home. And prior, all I could do is offset that payment. So if I'm paying $500 a month, even though I'm getting $2,000 a month rent, I could only offset that. And once again, this is a primary residence that you're moving out of, so there's no rental history there. But if you have rental history with other real
Mhm.
estate that you own, now I can use that $2,000 as opposed to just getting rid of that $500, right?
Exactly.
Does that make sense?
Yep.
Okay, perfect. Okay, so that's another positive change, right?
Absolutely. We like positive
This
changes.
is good news. This is good news here. Okay, so now changes for business for self. There's some changes, coming down the road with that. So what does that look like?
Absolutely. So Fannie Mae had actually come out with an announcement. Normally, if you are a self-employed borrower, it's pretty much standard. You're going to need 2 years of tax returns.
Right.
2 years of tax returns. You calculate income, averaging those 2 years. You had a rough year. I don't know, maybe there was a pandemic,
Exactly.
impacted your business in a negative way. That's going to impact your qualification and what you can do to get in. So now what we're looking at, and this is taking effect in January of this year, so it's
Okay.
not just yet, but for new loans coming in January of 2024, for the most part, you're going to be allowed to use only 1 year of both business and personal tax returns. As long as they've been self-employed for 5 years,
Right.
you got to have the business consecutive for 5 years, things like that. But if you've got your business for 5 years, and many borrowers we've seen have that,
Right.
well, you're showing stability there, so we're going to be able to utilize only 1 year tax returns. And the less documentation in a mortgage file always makes things a little bit easier.
Oh, and that's huge because, like you mentioned, with COVID, with the pandemic, a lot of businesses had some lean years at that point, and when you're averaging those two, you may have made $200,000 one year. Let's say last year, 2023, but then in 2022 or 2021, whatever the case may be, it could have been half that, 100,000, and now you're forced to average those two together, which is reducing qualifying income. Right?
Absolutely. And there's many self-employed businesses that were negatively impacted by the pandemic.
Absolutely. Okay, so gifts. There's some changes with gifts. So what are those?
Yeah. So actually, one of the big changes that came out is with again on conventional financing, the seller, if the seller is an acceptable donor, right? So as far as an acceptable donor, we're talking generally relatives and spouses or fiancés.
Right.
There's specific definitions for that. But if they're an acceptable donor and they're not an interested party, so you can't be the seller and the realtor
Right.
and be giving a gift, they can actually now give a gift towards the borrower. And that was something where it was very difficult, near impossible to do. Gift of equity they could do. That's where they basically gift value of the house.
Right.
But an actual cash gift wasn't allowed, and now they can give that cash gift, and that's a real big help, and going to help a lot of people qualify.
Okay, so let me understand this because we would always do gifts. So let me understand the difference. So if a mother or father wanted to give a gift, we could always do that. So what is the distinction? What are you saying is the difference?
So the big difference is if the mother and father was the seller, then they wouldn't be able to give that cash gift because they're considered an interested party in the transaction.
Okay.
Now, if mom and dad are selling a home to their child, then and the child needed a cash gift for closing, whatever it is, paying down debt, whatever you would use a cash gift for, mom and dad now can give that cash gift and help them qualify, even though they're the seller, as long as they're not, the realtor, loan officer, or something else involved in the transaction.
Very good. So just a little bit more leniency with the gifts, basically.
Absolutely.
So just expanding out a little bit more. Okay, so is that pretty much some of the changes that are just happened or are happening? Did we pretty much cover everything?
Yeah, I mean, those are certainly some of the big ones as far as actual rule changes that have come out that we're expecting. And again, as we're seeing, there's tweaks, there's changes, there's wholesale rule changes. Things are happening all the time. Fannie Mae, Freddie Mac, these agencies, they're evaluating the rules all of the time, and we're seeing, changes based on those evaluations.
Okay, and then when we say Fannie Mae, Freddie Mac, we're specifically talking about conventional financing. FHA, VA, they have different rules, just to be clear.
Absolutely.
As far as that. So we're talking about conventional financing. Okay, so let's talk about underwriting. I've read a couple articles that, it may be getting a little bit more difficult with underwriting, who knows. So on the front lines, you seen, running things through the automated system, which is called DU. Or are you seeing anything, tightening up as far as that's concerned?
Yes and no. So first and foremost, in the mortgage business, we use automated engines, depending on whether it be a conventional loan. There's DU for Fannie Mae, there's LP for Freddie Mac, and we have other automated tools that are utilized for government loans.
Right.
But basically, every loan kind of has to go through an automated tool. And conventional, you really got to get an approval through this automated engine. And the automated engine is very robust. It's been around for decades, and they keep improving it as far as what it can do.
Right.
One of the big things that we've seen recently is, especially with DU that's had some announcements come out, DU appears to be taking a very holistic look at the borrower. So whereas, for example, before maybe it was look kind of at the credit score, it's looking not just the credit score, but the credit score plus the credit quality, plus the credit history, credit depth, assets. Where are assets coming from? Gift, personal funds, grant, things like that. And what we're seeing is essentially a shift in some loans that we would have expected previously to see an approval.
Right.
We're not seeing that approval now for a myriad of reasons. So there definitely has been some sort of tightening that we are seeing. But on the flip side, Fannie Mae also just recently announced with their automated engine DU that it's no longer going to look at the number of borrowers as a risk factor, because it used to look at if there were two borrowers, okay, that's good, but only one borrower, that actually added a little extra risk to it. So
Right.
that could impact the findings and the potential approval. By removing that, that's going to make a big impact, I
Right.
think. You're going to, mainly, primarily on single borrowers.
Okay, perfect. So a mixed bag,
Correct.
basically.
Mhm.
Okay. Now, let's just talk about the lending industry, the mortgage market, just in general, when it comes to that. Now, we've seen, and realtors know this as well, we went from over 6 million, houses being sold down to like 3.94 million now. So, there's been, a softening of the market without question. So, now, and also Fannie Mae they just had their survey. They do a monthly survey,
Mhm.
and they talked about 84% of buyers saying it's a bad time to buy, which is a 39-year low. So, is there any good news, just on, the housing front? Because this is a good news show right now. We're talking good stuff here, right? So, I know interest rates came down. So, can you talk about that a little bit?
Absolutely. So, anybody who's been following mortgage rates for the last couple of years, they're just watching graphs go up and up and up, and that's all it is. Just been up and up, and huge jumps. We've seen larger jumps and increases in rates now than we have in decades, or over a decade.
Right.
However, we have seen a little bit of a leveling off recently.
Right.
And we're recording this in mid-November,
Right.
before Thanksgiving, and we have seen rates kind of for the first time in like a year actually start trending down.
Right.
We hit a high, around 8-ish%,
Right.
based on, depending on which survey that you're looking at, and it's now come down to mid to low sevens.
Right.
Again, depending on which survey, there's many different surveys you can look at for those rates at the times. And that's the average. So that's a huge drop that we're seeing. And with lower rates, improves affordability.
Right. Absolutely.
As the rates come down, more people can buy. Rates went up, and we saw it. Rates skyrocketed, and people couldn't afford it. They came out of the sidelines. And as rates go down, well, those people on the sidelines are able to now come out. And I understand home buyer sentiment, wanting to wait and being concerned, but rates are a little bit more stable.
Right.
And one of the best ways to build wealth in this country is through homeownership.
Right. And then on Bright, I just saw that there's approximately 4,500 homes for sale in the Philadelphia area, and 50% of them had price reductions. So you take the fourth quarter, November, December, and even January, the market softens, and we're starting to see that, price reductions are starting to come down a little bit. I mean, no major shakes, but they're coming down. And now with interest rates falling, a little bit, the combination of those two, these are some conversations that, loan officers, realtors should be having with their clients, because a lot of these clients are on the sidelines. They're not doing anything, and they may not know that, hey, prices have come down a little bit. Interest rates have come down a little bit, right?
Absolutely. I think one of the challenges, if I were to put myself in a frame of mind as these home buyers that are they're not looking at a positive outlook, right? Why would I think that? Well, I've seen low inventory. I've seen, many areas less than a month inventory. So inventory is a big issue. And well, economics 101, supply and demand,
Right.
right? Supply is super low. Demand, people need a place to live. They
Right.
want to buy houses. Demand is high. So, well, that must mean that prices are just going up and up and up.
Right.
But the extra factor, the X factor that's not taken into account is the affordability.
Right.
Money is a finite resource, right? There's only so much that people can afford.
Right.
So at some point, to be able to sell those houses to the people in the market, the prices do have to come down. And we are seeing that, as you mentioned, with that report in
Right.
Bright MLS. People are, dropping some of their prices. So it's still worthwhile getting out there. People need to be having conversations with potential borrowers, whether they be a realtor, whether it be a loan officer, or just a friend who happens to be a homeowner.
Right.
Is that it's still worthwhile going out looking where you can make that investment. Unfortunately, some people, affordability is a factor. They just will never be able to afford the home.
Right.
It will be too much for them. But I think there's probably people sitting on the sidelines that can afford it and don't realize that they can,
right.
because of some of the changes that are coming, or
Just
people
the
being
headlines.
more willing to negotiate.
Right. And just the headlines, what they're seeing, because, people are more attracted to the gloom and doom, that's, more clickbait, people are going to look at that, more so than not. So, and I just know for myself, hey, if I had to speak to 10 people before to get a transaction, well, now I may have to speak to, 20 or 30 people. And that's the whole point. Hey, you really should be talking to your buyers and sellers and say, hey, do you realize that interest rates have dropped? If that's one of their sticking points, or that, price reductions on listings. If the market was so hot and so great, then why is there 50% price reductions, right? So that's something to talk about. And once again, real estate is local. Every market's a little bit different. I was just citing, something from Philadelphia. Right. Okay. So just to wrap everything up, is there any other bit of good news, out there that we haven't covered? Because, hey, there were some, good things.
Certainly.
Positives, as far as the housing market is concerned.
Sure. There's actually one thing I love about your show.
Oh, that's right.
Is
adjustable, right?
Yep. One thing I love about your show is that you have experts that come on, and I love watching it when you have those experts, because I learn something new, whether it be about your attorneys that you have on talking about past news and things of that nature. So I want to be able to bring my little expertise, and I just wanted to talk real briefly about something that's not new,
Right.
but hasn't been utilized in, well, probably since the early 2000s,
Right.
and that's ARMs. With the rise in rates, whenever fixed interest rates rise, you always suddenly start hearing people talk about ARM, or adjustable rate mortgage. Because historically, ARMs have been lower rates than fixed rates.
Right.
That's not always the case. It may not even be the case right now, but when rates are higher, people are looking for alternative options. So I just wanted to talk about what an ARM kind of is, and at least some of the basic information that's needed, and basic terminology.
Right.
Right. So an adjustable rate mortgage generally is fixed for a certain period of time, and then it adjusts after that. So you'll hear terms like a 5-year ARM, a 5/6 ARM, or a 5/1 ARM.
Right.
Believe it or not, that's two totally different things between the two. So the 5-year fixed is really just talking about the fixed period. And
Right.
generally, they fully amortize over 30 years. So the whole term is generally 30 years. 5-year fixed means it's fixed for 5 years. A 5/6, it's literally 5/6 when written out, means that it's fixed for 5 years, and it adjusts every 6 months thereafter.
Right.
And a 5/1 is it's fixed for 5 years and adjusts every 1 year thereafter. And it could be a 7-year, 7/1, 7/6, whatever it might be. So that's kind of what's really important to know is, okay, how long is it fixed for? And when is it going to start adjusting? Then the other important part to know is, okay, how much can it adjust?
Right.
Right? And you'll hear terms about, oh, it's got caps. For example, maybe 525 caps. Great. You just threw out three numbers at me. What the heck do they mean?
Right.
Um, the first cap is the first adjustment rate cap. So when it adjusts, what's the most that it can adjust? Well, if it's a 525, that means 5% is the most it can adjust in that very first adjustment.
Right.
The second one is your subsequent rate cap. So every 6 months or 1 year, what's the most it can go up? 2%.
Right.
And again, in that example, and then your life cap, because it's got to cap it. You don't want to end up at a 30%
Right.
interest rate rise. And that's what that life cap is. So at some point, that's the max. Now, the caps just mean that's the most it can go.
Right.
The increase or the change is based on the market. So when you have your loan, you're going to be locked in based on a margin, which essentially is, okay, that's your kind of the fixed portion of your adjustable rate, and an index.
Right.
One of the most popularly used indexes right now is SOFR, or Secured Overnight Financing Rate. The key is the index has to be published somewhere, and this is available right on the Federal Reserve's website. You can see it anywhere. So when you're given your initial lock-in, this is my margin. That doesn't change, and this is the index. Okay, great. So I know when it's coming up to the change period, I go look at the index. Well, where is it? Is it higher? Is it lower? Is it the same? And you can have an idea of where your rate's going to go. So, for example, that if you got a 5% max increase on the first adjustment, well, if the index only went up by like a point, then your rate's not going to go up 5%. It's only going to go up like the point. So I think that the caps sometimes scare people because they think that's how much it will adjust.
Right.
That's just how much it could potentially adjust at most. And that's what's really important. And we have seen, like back in 2005, almost 40+% of the loans were ARMs. 2021, only 4% of loans done were ARMs.
Right.
And, so we're seeing an increase now in the popularity of this. And I think it's just important that people kind of understand it. It is an option, and they have to understand the whole loan to understand if that's the best option for them right now. Is that something that they feel is going to work to their advantage? And, again, in 2005, for 45% of people it was,
right,
but 55% of people it wasn't.
Right. So let me elaborate. So the margin is the fixed portion. So let's say if hypothetically the margin's 1%, my index is, can move up and down because it's an index, is 5%. Well, then I'm looking at a 6%. The 5 plus the 1 equals the 6. So, 3, 4, 5, 10 years down the road, because you could do 5-year fixed period, 7 or 10. Well, so whenever your fixed period is over, if that index is 4% plus 1, well, your rate's not going up. But if that index went from 5 to 7 plus 1, now you're at 8. So that's what you end up having. And ultimately, from my conversations with people, it's, do you believe interest rates are going to go down over time? Because it really doesn't make sense to do an ARM product if you believe interest rates are going to be high or continually going up. It makes no sense. You get a 30-year fix. So if you believe interest rates are going to go down, then why am I paying a premium for a 30-year fixed when I'm not going to keep it because I'm going to refinance?
Absolutely.
So that's the mindset. Hey, in the next 5 years, in the next 7 years, in the next 10 years, do I believe interest rates are going to go down? Do I take the savings right now because I know I'm going to refinance? Because, hey, if I have a 7.5% interest rate and interest rates go to 5.5%, I'm refinancing. It doesn't matter if I have a 30-year fix or if I have an ARM, because I want that lower payment, just like, millions upon millions of people did, in 2021, and 2020, 2021, and 2022. So yeah.
And it's absolutely important to, if you are considering an ARM, right, or if you're a real estate professional talking to somebody who's considering an ARM, they really need to know, what is the index based off of? And what is that margin? That margin is so vitally important because it's the fixed part, right? If that margin itself is 5%, I mean, then okay, that's how it's definitely never going below that, because an index will never be zero.
And that's what happened in 2023, 24, 25, those margins were so large that no matter what, when your 2 year, 3 year period came due, those rates went up.
Mhm.
So that was the negative thing. Now the margins are a lot,
Right.
leaner as
And
far as that's concerned. Yeah.
Exactly, and that's you're right. The margins, for the last decade, the margins have been huge because the indices have been so low
Right.
and the rates have been so low that and that's why nobody did an ARM, because an ARM was a worse rate than a fixed rate
Right.
mortgage.
So perfect. Well, Jason, thanks for being on the show. Some good information, some positive information, I believe. Go out there, have conversations with your people as far as interest rates being lower. Maybe price reductions on homes. Have those conversations. Super important. Well, that's the Real Estate Show with Pat Lopez. Be sure to follow the show on Facebook, Instagram, and subscribe below. Okay, super important. I have great guests on all the time talking about the real estate market. Also, leave a comment. Tell me some things that you liked, you didn't like, and also let me know some future topics you'd like me to cover in the future. Remember, this show is everything real estate, no limits. Hope you enjoyed the show and have a great day.